Everyone says they want to own a rental property, but what they don't tell you is that not all rental strategies are created equal. Let's explore how long, mid, and short-term rentals stack up for real estate investors. Long-term rentals, which typically rent for at least a year. The pros. They're the most consistent financial rental option as you lock in a tenant for a longer period of time. The tenant typically pays for all utilities. You likely won't have to furnish the property. You get to vet your tenants a lot more thoroughly. It's the easiest to finance and has the most affordable property management costs. Cons. It has the lowest profit potential of the rental options and has a fixed rent price. If you select a bad tenant, you'll have to deal with them for a longer period of time. The property may require significant repairs or upgrades before it is rented out again between tenants, increasing turnover costs. It's subject to strict landlord-tenant laws, and the tax implications sometimes can be complex. Midterm rentals, which typically rent for over 30 days, but less than a year. The pros. They have the ability to profit more than long-term rentals. They also offer more stability than short-term rentals and more flexibility than long-term rentals. They have the ability to adjust rental rates seasonally or based on demand, capturing higher rents during peak seasons or special events. There's less wear and tear on your property due to fewer turnover than short-term rentals, which reduces maintenance costs over time. Cons. You'll likely have to furnish the property and pay for utilities. They also have a higher vacancy potential compared to short-term rentals. They have more turnover than short-term rentals. Demand can be more sensitive to economic changes such as corporate travel policies or shifts in remote work trends, leading to potential volatility. Short-term rentals, which are 30 days and under for renting. The pros. They have the ability to profit the most out of any type of rental category by a huge margin with dynamic pricing. They're the most easily adjustable, like pricing, availability, and how the property is used. Bad tenants or guests are only temporary, potentially drives up the value of the home, and it has the lowest risk of non-payment. Now the cons. You essentially run a hospitality business, having to ensure guest satisfaction at the forefront. There's also potentially a consistent income. You'll have to furnish, coordinate the cleaning of the property, and pay for utilities. Properties are sometimes harder to find because of HOA rental restrictions. In cities like Scottsdale are starting to get way stricter with short-term rental requirements, and they're the most expensive type of rental to manage. Comment below on which strategy you found most successful with or are most interested in.